Brigden, the co-founder of Macro Intelligence, two partners now joining us live on this Monday's edition of The Market. Good morning, Julian. Good to have you on the show with us. We all saw what happened on Friday. We also saw the way the two-year Treasury yield reacted, the highest since 2008. We saw the brief inversion on Mint Street in the bond market as well when we look at the yields. This Monday, as we head into Wednesday's crucial meet outcome of FOMC, how should one be looking at capital flows, be prepared for all kind of hot swings and brace ourselves for maybe 75 basis point rate hike?
I mean, I think 75 has to be considered. I mean, the CPI data and the increase in inflation expectations we saw from the Michigan number are an unmitigating disaster, frankly, for the Fed. I think people have failed, at least the market has failed to take Powell at his word. This is a gentleman who's been absolutely clear. In an interview which he did on NPR a few weeks ago, he essentially made a solemn pledge to the American people that he was going to prioritize bringing down inflation, and I think he is. And, you know, it's tough to say that from what I'm hearing, they've all read the notes from 1973 and 1974. They're all determined that this is not going to be an Arthur Burns Federal Reserve and allow inflation to escape, as was the case in the 70s. And I think you have to look at an extraordinarily tough Fed. I think we may even need to consider the possibilities that we certainly don't get a pause in September, as Bostic has suggested. And I mean, that's what dissenting is for. If you don't like what the boss says, you can dissent. And it's not a democracy, the FOMC. It is very much decided the direction by the chairman. And I think we need to be prepared for, as I said, no pause, maybe not even 25s. Maybe we're just going to see a series of 50s through year end.
Julian, you know, central banks around the world are tightening rates. The ECB, which hasn't raised rates since 2011, is perhaps going to be doing it very soon as well. In America, we're talking about 50, 75, which is very much at the table. But one looks at the bond market, and is that what is really spooking there for the equity markets as well? Yes, you will react to an 8.6% inflation reading, but the fears of a recession, the ugly R word, is that what has the markets also more spooked than ever before, that it's here or it's going to be here?
I think the market, I mean, this is partly the dilemma that we face. I mean, I think the market is trying to look desperately to see if they can see signs of recession. But ironically, the work that we do suggests that it's not actually the economy that leads the markets. It's actually the market that leads the economy, and that's through the behavior of CEOs. And you can already see it with stocks under pressure. CEOs are starting to advocate cutting costs. We've seen it from the likes of Coinbase and other sort of leading edge tech firms. And I think, unfortunately, that's what's probably going to happen. I think if we have a very, very overvalued equity market in the US, I think arguably with analogies that look very similar to the dot-com bubble, I think as that unwinds, it'll be that that'll drive us into recession. So I think the risks of a recession are really growing. And I think that the Fed, I mean, it's obviously not what they want, but I think my sense is they're beginning to prepare themselves for that eventuality. If that's what it takes to bring down inflation, that's what they are determined to bring that down. And so if they have to see a recession, then it will be a recession.
So, Julian, seems like we're going to have to bid adieu to the bull market, which was a dream run from the 2020 lows all the way to the start of this year. Actually, technically, most of the US indexes are already in a bear territory.
Right. Yeah, and I think that's possible. I think, you know, I mean, my personal target for the S&P is down towards the low 3,000s. I think that's realistic. You know, erase basically all the gains of the COVID period. That would be enough, typically a 30% correction. If you look at the statistics going back 90 years, barring 1987, which was more of a flash crash as opposed to a true bear market, a 30% correction in the S&P top to bottom has always given you a recession. The problem is we don't always stop there. I mean, I think we probably will. But at least for the moment, yes, you're absolutely right. You can kiss goodbye to the bull market. Those days, I'm afraid, are over.
So Julian, what is it that we're looking at? Because, many investors that we've been speaking with, and I was chatting with Chris Wood just the other day, they're all saying that it's time for China to outperform. China is being looked at as some sort of a safe haven. India also has been, crashing amidst this global market meltdown, if I can call it that. Also because China is that bottom-up story that one can play.
I think there's a few, don't get me wrong, I think there's a few sectors that you can play. I mean, I like the energy resources, the sort of mining, the metal, certain emerging markets on the back of that. China's cheap, so that's okay. The problem is in this phase, if you go back and you look at that dot-com period, in what I refer to as the sort of nasty correction, which is the initial correction you got off the highs, it was very hard to get absolute outperformance of almost anything. There was quite a lot of relative outperformance. So I could see China relatively outperforming a US tech sector. I could see mining and metal relatively outperforming. Does it absolutely rise if you drop the S&P another 20%, 30%? Kind of hard.
Okay, we'll chat when the markets fall further. Seems like they would. Julian, great to have you today on ET Now.
Thank you very much indeed for having me.
Thanks.